This decade's greatest investment opportunity is still Nvidia. It may even be the greatest experience of your life. I believe that Nvidia's revenue scale will likely remain the same for the next 2 or 3 years. What is the terminal value, however, is the actual query. Eventually, many realized that the value would shift to other sections of the stack, namely the application layer, as Sack demonstrated in that Cisco slide. Additionally, Cisco's revenue, multiple, and credit decreased as more and more funds were raised at the Internet's application layer. And since Cisco's income kept increasing, that isn't a bad thing. It's Monday, and the U.S. markets are in for another week. Caroline Woods is at the New York Stock Exchange this morning with some analyst notes and commentary. So, Caroline, how about we discuss Nvidia? Indeed, Nvidia is always making news and is receiving another price target increase on Wall Street. However, a quick glance shows that shares are rising, up roughly 0.7% this morning. They were up 9% last week, up 20% so far in June, up 166% so far this year, and, as I mentioned before, up a little less than 1% today. Susanna-based analysts increased their price objective for shares to 160. We'll go over why Nvidia is expected to grow significantly and why its stock is a good investment over the course of the next 10 minutes. In the market for AI chips, Nvidia has solidified its position as a leader. The need for AI technology is rapidly growing in a number of industries, such as healthcare, banking, and the automotive sector. At the heart of this technological revolution are AI chips, which allow for more complex machine learning algorithms and speedier processing. For AI applications, Nvidia's cutting-edge GPUs, graphics processing units, are now the industry standard. Because these processors are built to withstand the massive processing demands of AI jobs, Nvidia is the preferred supplier for businesses wishing to incorporate AI into their operations. In the upcoming years, the market for AI chips is anticipated to expand considerably. Industry predictions indicate that as more industries embrace AI technologies, the market may grow to previously unheard of heights. The growing dependence on AI for data analysis, automation, and decision-making processes is what is driving this increase. Nvidia is in a great position to benefit from this development. It stays at the forefront of this expanding sector because of its ongoing innovation in AI technology and software. By consistently enhancing the functionality and efficiency of its chips, Nvidia is not only meeting but also surpassing demand. Nvidia's strategy is centered on innovation. Resting on its laurels is not enough for the corporation. Rather, it continuously pushes the limits of what its technology is capable of. Significant performance gains brought about by recent developments in Nvidia's chip design have strengthened the company's competitive advantage. For example, the Hopper GPU architecture, which Nvidia just unveiled, marks a major advancement in AI processing capacity. As AI models get more intricate and demanding, this new architecture promises to deliver performance never before seen. Yes, and they performed a fantastic job, however the worth was reduced. Accordingly, Friberg, if we look at this chart, the Netflix and Cisco chart winners may actually be someone similar to Netflix. In fact, they managed to get hundreds of millions of customers to pay them money. Facebook and Google are also responsible for all of that traffic, and YouTube is a natural next step. In your opinion, who is the application layer victor in this case? Who are the billions of customers who will spend $20, $5, or any other amount each month? Well, let me begin with this crucial issue. Large cloud service providers are the source of that revenue, to Chat's point. As a result, Google and other companies are creating clouds on which other application developers can construct their AI tools and applications. Therefore, a large portion of the build-out is located in cloud data centers that are owned and run by these large technology corporations. Although Nvidia made $18 billion from its data center, the businesses that are expanding do not consider it an operating expense. Thus, this is a crucial factor in explaining why things are happening so quickly. Large corporations purchasing these chips from Nvidia are exempt from accounting requirements to record the purchase as an expense on their income statement. In the cash flow statement, it is actually recorded as a capital expenditure. Over time, they depreciate it and record it on the balance sheet. Because Google and other companies have $100 billion in cash on hand, they are able to invest $20 billion. Additionally, they have been having trouble figuring out how to expand their company through acquisitions. The other is that all of their purchases are being blocked by antitrust authorities. What do you do with all that money then? The next generation of cloud infrastructure may be built out without negatively impacting your profit and loss. After it is recorded on the balance sheet, it is depreciated over a period of 4 to 7 years. Thus, over a 7-year period, that money is distributed on these large corporations' income statements. The big cloud data center providers are stepping in and saying, "This is a great time for us to build out the next generation of infrastructure that could generate profits for us in the future because of the excellent accounting and M&A environment. Since we have so much cash on hand, we don't need to take a blow to our P&L or buy a company that is expensive. And to be honest, antitrust laws will prevent us from expanding through M&A at this time." As they look for methods to expand, a number of additional driving forces are contributing to this short-term increase. Due to length restrictions, continued in the following response. A continuation of the last response. Yes, let's discuss the performance of Nvidia's stock. Nvidia's stock has been rising recently, which is indicative of the company's strong growth and promising market. As a result of the company's strategic posture and investor confidence, Nvidia is currently the second most valuable stock in the world. Impressive financial data support this stock's explosive increase in value. Nvidia's data center revenue, for instance, increased by an astounding 427% year-over-year, $22.6 billion. This expansion demonstrates the growing need for AI solutions in the data center industry, a trend that is probably here to stay. Nvidia has demonstrated outstanding financial performance. With its recent profits per share announcement of $6.12, the company comfortably outperformed the average forecast of $5.60 per share. Nvidia's operational effectiveness and market domination are evident from such high earnings. Furthermore, Nvidia's outstanding 78.4% gross margins put it well ahead of the competition. High margins further increase the company's profitability by demonstrating its capacity to command premium price for its cutting-edge products. Analysts' optimism in Nvidia is understandable in light of these considerations. Despite the recent spike in its stock price, many people think Nvidia is still cheap. Nvidia is a fascinating investment opportunity because of its strong market position and the predicted expansion in the AI industry. In summary, Nvidia is influencing the direction of AI technology in addition to dominating the market for AI chips. Nvidia is in a strong position to hold on to its market leadership thanks to its exceptional financial performance, strong track record of innovation, and clear growth trajectory. Many investors believe that Nvidia is a good investment since analysts are upbeat about the company's prospects. I am aware that it was an accounting point, but I believe it to be a very significant and legitimate one. If $100 billion is spent this year, you divide that amount by 4, which means that $25 billion in revenue must come from it or something like. Yes, and so, any guesses, Sachs? Just remember that what you mentioned, Freeberg, is probably true for GCP spend, but not necessarily for Google spend. While it may not always be the case for Amazon spending, it is true for AWS spending. Additionally, it applies to Azure spending but not to Microsoft spending. Furthermore, since Facebook and Tesla lack clouds, this is mostly untrue. So, to your point, I believe the question is, how much of that $21 billion that just went to those cloud providers will they then expose to everybody else versus what was just absorbed? Nvidia doesn't publish it for obvious reasons. That's all from Mark, isn't it? He had that video on Facebook about how many H100s. My point is that it is still capitalized. Therefore, they are not required to record that as an expense. They have the ability to earn it down over time, and it is listed on the balance sheet. You're contributing to the explanation of these large cloud service providers' high expenditures. So cash, because they're highly profitable, and you can't put the money anywhere else. Isn't that right? Thus, it would appear that this falls more in the category of one-time build-out than steady long-term revenue. The main query, in my opinion, is the one that Jimath posed. What is Nvidia's terminal value? What is the GPU's total addressable market, TAM, and what will be their market share, in my opinion, is a straightforward framework for considering that. Their current market share is approximately 91%. That will undoubtedly be defeated, but their moat seems to be huge. According to the Wall Street analysts I've been listening to, their market share will still be in the 60s in 5 years. They will therefore have a sizable portion of this.